Whenever the economy starts to shift into a recession or interest rates climb, a lot of investors make decisions they don't realize are mistakes until it's too late to fix them. The reason isn't the recession itself, it's how they're reacting to it. And with the odds of an upcoming recession increasing daily, I want to make sure you'll be able to avoid making the same mistakes. Hi, I'm Josh Palmer, Director of Financial Planning with the Noble Group. I'm a certified financial planner with over 25 years of experience working with families and individuals to build clarity on their money and confidence in their financial futures. Be sure to stay until the end of the video because we'll give you a chance for greater clarity on your retirement picture with a free review. When it comes to recessions, the first thing I tell people is this: they're normal. They're part of the economic cycle. They've always existed. They will continue to exist, and they serve a purpose in the long arc of economic growth. Markets expand, markets contract, and then markets expand again. But what throws people off is the emotional intensity that recessions create. When you turn on the news, everything sounds urgent, everything sounds dramatic, everything sounds apocalyptic. But headlines are designed to capture attention, not to guide your financial life. The truth is much calmer than the headlines suggest. Recessions are not anomalies. They're expected. And when you understand that, the fear begins to shrink. The second thing I emphasize is that high interest rates are not inherently negative for investors. They change the environment, but they do not destroy the environment. High rates impact borrowing costs, mortgage affordability, corporate debt, and economic growth, but they also increase yields on bonds, savings accounts, and money market funds. They create opportunities in income-producing investments. They help cool inflation, which preserves long-term purchasing power. In many ways, high interest rates are simply a rebalancing mechanism. They shift risk, they shift behavior, but they don't eliminate opportunity. What matters is how you respond. When investing during a recession or high-rate environment, the most important principle is to keep your long-term strategy intact. The temptation to abandon your plan becomes loud. You start questioning whether your allocations are correct. You wonder if you should reduce risk. You wonder if you should wait for the right moment to re-enter the market. But the moment you shift into emotional decision-making, you lose the advantage of compounding. Markets recover unpredictably, often before the economy feels better. If you wait for good news to return, you miss the early upswing. Historically, the market's strongest gains tend to occur near the end of recessions, when emotions are still negative. You cannot capture those gains if you abandon your strategy. One of the questions I hear most often during downturns is this: should I move to cash? And my answer is always based on the same principle. Moving to cash is not a strategy, it's a feeling. Cash has a purpose as liquidity, as a short-term buffer, as stability, but it is not a wealth-building tool during long-term investing. If your portfolio is properly designed for your risk tolerance, you should not need to move to cash because of market fear. You should already be positioned to ride out volatility without panic. Cash is a stabilizer for emergencies, not a hiding place from volatility. Another key principle during recessions is rebalancing. This is where disciplined investors quietly outperform emotional ones. When markets drop, your equity allocation declines. Your bond or cash allocation becomes overweight. Rebalancing forces you to sell what has held up well and buy what has dropped, which means you are buying stocks at lower prices. It's uncomfortable. It feels contradictory, but it is mathematically sound. Rebalancing is one of the purest forms of buying low and selling high without trying to time the market. And it works because it's consistent. It removes emotion, it forces discipline, and it positions your portfolio to capture potential for recovery when it arrives. Another major consideration in high-rate environments is debt. When interest rates rise, the cost of carrying debt increases. This is not the time to be overloaded with variable rate loans, high-interest credit cards, or debt that strains your cash flow. In high-rate environments, I encourage people to evaluate their debt structure proactively. Secure fixed rates when possible. Reduce balances that carry high interest. Align your debt with your income in a way that reduces pressure, not increases it. Debt is not inherently harmful, but in a high-rate economy, it becomes heavier. And heavy debt limits your ability to take advantage of investing opportunities. Now let's talk about asset allocation during recessions. People often assume that they need to shift into more conservative investments when the economy slows. But this is usually a reaction, not a strategy. If your portfolio is built correctly, meaning your equity exposure matches your risk tolerance and your timeline, then adjusting your allocation during a recession is not necessary. In fact, it's counterproductive. Your allocation should already reflect your capacity for volatility. If it does not, the problem is not the recession. The problem is the original allocation. During downturns, the goal is not to reduce volatility, the goal is to maintain structure. One area that does change meaningfully in high-rate environments is the bond market. Bonds become more attractive because yields rise. For years, low-rate environments have made bond investing feel underwhelming. But when rates rise, the fixed income side of your portfolio becomes a real contributor again. You earn higher yields without taking on increased risk. This creates an opportunity to strengthen the defensive side of your portfolio while still staying diversified. People underestimate how valuable high-rate environments can be for savers and retirees. Income-producing investments become more rewarding. Cash reserves produce meaningful interest. The less volatile side of a portfolio finally pulls its weight. Now let's address a common worry. What if the recession lasts a long time? And the answer is simple. Recessions are temporary, but long-term investing is not. You are not investing for the next 6 months. You're investing for the next 20, 30, or 40 years. A recession is a chapter, not the story. I've walked hundreds of people through market cycles, and the pattern is always the same. The people who stayed invested have historically recovered. The people who panicked did not. The people who remained disciplined emerged stronger. The people who reacted emotionally lost the opportunity that volatility creates. Because I always try to emphasize this. Volatility is not the enemy. Volatility is the reason long-term investors earn higher returns than savers. If markets were stable, returns would be low. Volatility is the price of admission for long-term growth. But when you understand that volatility is normal, not a sign of failure, you stop interpreting every fluctuation as a warning. Instead, you see it as part of the process. And when you accept the process, you can stay committed to your strategy. Another important mindset shift during recessions is to stop focusing on predicting the bottom. People waste enormous emotional energy trying to guess when the market will turn around. But bottoms are only obvious in hindsight. You do not need to buy at the bottom to succeed. You simply need to buy consistently. When you contribute regularly, even during downturns, your average cost drops. Your long-term returns increase. This is the heart of dollar cost averaging. In recessions, every contribution becomes a strategic advantage because you're buying at undervalued prices. And disciplined investors take advantage of it, even when it feels uncomfortable. In high-rate environments, it is also important to adjust expectations. When rates are high, economic growth naturally slows. Companies borrow less. Consumers spend more cautiously. Markets may move sideways. But sideways markets are not wasted time. They're building time. There are accumulation phases. These are periods where disciplined contributions have the greatest long-term impact. When markets run upward rapidly, every dollar buys less. When markets move sideways or downward, every dollar buys more. Your contributions work harder during slow periods than they do during booming ones. Another thing I tell people is that recessions and high-rate environments are outstanding opportunities for self-awareness. These are the moments when you learn your true risk tolerance. Not the risk tolerance you write on a questionnaire, but the emotional reality of how you respond to uncertainty. When you discover that reality, you can calibrate your portfolio more accurately for the future. Recessions expose misalignment, and misalignment is something you can correct. One of the biggest mistakes people make in downturns is comparing themselves to others. They see headlines about people winning during recessions, individuals betting on specific sectors, shorting certain assets, or speculating aggressively. But what you do not see are the losses those people take when their strategies fail. High-risk strategies make noise. Disciplined strategies aim to create wealth. Your job during a recession is not to outperform others. It's to preserve your plan, stay aligned with your goals, and maintain consistency. Now let's talk about real opportunities during high rates. High yields in bonds, CDs, and money markets can allow you to earn meaningful returns with minimal risk. This is a gift for conservative investors and retirees. It can potentially help safeguard portfolios. It can enhance cash flow. It can help strengthen the defensive side of long-term planning. High rates also create opportunities in real estate as prices adjust and competition decreases. Investors who are patient during high-rate periods often find attractive deals should rates eventually fall and demand rises. Economic cycles always rebalance, and patient investors benefit during the transition. In recessions, the greatest opportunities often appear in sectors that have strong long-term fundamentals but experience temporary declines. You do not need to pick winners. You simply need to stay in the game. Broad diversification aims to help you capture recovery wherever it occurs in tech, healthcare, energy, real estate, or international markets. You do not need to guess, you need exposure. In the end, investing in a recession or high-rate environment comes down to a few core truths. Your strategy should not change because the economy changes. Your strategy should be built to withstand these moments from the beginning. If your plan only works in good times, it's not a plan, it's a hope. But when your plan is grounded in long-term principles, diversification, discipline, rebalancing, appropriate risk, and consistent contributions, you do not just survive downturns, you can benefit from them. So to start building your plan, click the link in the description or scan the QR code on the screen to let us know about your unique situation and schedule a free retirement review. And if you found this video helpful, click the like button and subscribe to keep up to date with our weekly content. Thanks for watching.